You're listening to The Real Wealth Show with Kathy Fettke, the real estate investor's resource.
Buying an apartment building might seem a little intimidating, but it doesn't have to be. Like anything, you just need to study the topic before you dive in. And you can speed up the process by using a mentor. I'm Kathy Fettke, and welcome to The Real Wealth Show. In today's episode, you'll hear from Brad Sumrok, who ditched his job, found a mentor, and started investing in multifamily apartment complexes about 20 years ago. Today, Brad and his wife Jen earn 7 figures combined from their real estate holdings and their real estate coaching business. And Brad is here with us today on The Real Wealth Show.
So Brad, welcome. It's so good to see you.
Yeah, hey, I'm excited to be here this evening.
So, the world is changing dramatically. At Real Wealth, our focus is more on 1 to 4 units. You've been a multifamily investor. Right now, I'm pretty jealous about that because you guys have had a good run. The last 2 years have been phenomenal. So let's just kind of start with who you are and when you got started investing and why. This is 3 questions. I'm loading you up. And why you have chosen multifamily as your asset class.
Yeah, so first of all, I'll just say I'm living this dream come true, right? I've been doing apartments for 21 years and never in my wildest dreams that I think I would be an apartment investor. And how it all started was, if I could just take a step back to before I started investing, I didn't come from money. I would say I was lower middle class, next pretty close to being poor, not broke, but pretty not well off by any standard. Neither of my parents graduated from college. And so they impressed upon me how important it was to study hard, get good grades, go to college, get a degree, get a job. And so that's what I did. I got a degree. I became an engineer because my dad worked for an engineer. And I remember when I was growing up, my mom used to tell me how my dad's boss made $80,000 a year as an engineer. And they would go to vacations in Hawaii. Now, I grew up in Pittsburgh. My family, on the other hand, would go to vacation in Lake Erie from Pittsburgh. And my dad and my mom would say things like, your father only makes $42,000 a year, and she would say this in front of my dad as he was driving our family to Lake Erie. So, my mom, she just wanted me to have a great life, and they didn't know about real estate and investing and entrepreneurial and even the stock market, or they didn't know about this whole other world. And so that's what I did. I went to college, got a job. I went to more college and got a better job. That was a master's degree, and got a better job, 6 figures. But I got fired once in my early, and that was a wake-up call. And then I got laid off 2 years later, and that was my second wake-up call. So I knew I needed to do something different, but I didn't know what to do. And so I don't even know if you know this, Kathy, because we've known each other for years, different events and stuff like that. Actually started for my law school, the LSAT. And then in the year 2000, the Rich Dad, Poor Dad book came out, and I read that book, and that book totally changed my life because I had never known those options existed,
Yeah.
And then I read the next book and learned about ESBI, employee, self-employed business owner, and investor. And so I got rid of the law school preparation and I sought out real estate education. I went to real estate seminars. And I was so skeptical because I was educated. I was like, I got 2 degrees and I was smart, book smart, but business stupid, And but that's how I got started. And then why apartments was because, Robert Kiyosaki in his book says you need to have investment income that covers your job income, and then you could get out of the rat race. In fact, they created this whole movement of like the cash flow game, right? You know what I'm talking about, where
Yeah.
you play the cash flow game and to get out of the rat race. And so my income was 10,000 a month. And, you know, Kathy, I don't know what you were doing 20 years ago. You're probably doing single family or teaching people single family and 1 to 4 units. But like what I learned at the time was a single family home would cash flow at maybe $200 to $300 a month, and I needed 10,000. So I'm thinking, oh my God, I need to have all these houses. And so, you know, I went to a seminar and I got a mentor. And I know that you know, it's no secret that I mentor other people, and I'm not being self-promotional, but like having a mentor and investing in my own education was critical because my first investment property was 32 units. And you know, my mentor told me, he said, buy the biggest property you can with the money you have. And at the time, he was not syndicating. So I didn't know anything about syndications. And that's a whole nother second part of my story.
Well, let me stop you there, because how do you get a mentor? People ask me that all the time. Like, how do you get a mentor? I mean, did you just hire this guy, or is somebody who just liked you and saw your potential? I mean, how does that work?
Well, it could be all those different ways. Like in that case, I went to a seminar and they offered a formal mentoring program. And by the way, when I went to the seminar, this was back in 2001, it was $500. And everybody, I was an engineer at work, and everyone at work on Monday or, you know, Friday before the seminar, they were like, oh, have fun this weekend. How, you know, hope you like that seminar. You know, they were kind of making fun of me. And, and on Sunday, they offered the mentorship program, and I'll never forget, you know, this was 20 years ago, it was $10,000. And you know, what would that be in today's dollars? I don't know, you know, 30 grand or 40 grand or whatever, but I bought it. And the thing is, I didn't want to be sold, but at the end of the day, I wanted to work with the guy. And he just said, hey, here's how I work. You know, I don't do lunch and dinner, and I don't do brain picking sessions. And so I bought it. And I was so embarrassed. I didn't tell. I went back to work Monday. I did not tell a soul.
How much did you spend?
Yeah, I didn't tell. It was 10 grand.
Oh, it was 10 grand. Okay. Yeah, that's a chunk of change. But I think you've made that money back.
Oh yeah. Like, so within 8 months, I bought my first deal. It was 32 units.
Yeah.
And then I bought my second deal 8 months after that. So within 16 months, I had 62 units. And then what happened is the people at my office started paying attention, because they would go to lunch and I would look at deals. They would go to happy hour and I would look at deals. And so what I found is that the people that are willing to do that extra effort little by little, you know, the consistent effort over time, instead of going to happy hour, I'm underwriting deals. On the weekends, they're going to the lake, and I was driving by deals. And but what started happening is over time, I started, you know, separating myself from the people in the engineering world. And within a couple of years, I had 62 doors, and I was able to quit my job. And that's how I did it. But you also asked, like, how, you know, there's other ways to get a mentor too. Like, there are people that have formal programs, and there's people, sometimes you just get somebody to take you under their wing, you know?
Yeah. Yeah, that's more rare. You know, most people who have achieved can't take on that many free mentorships, right? I mean, mine was a co-sponsor on my show, and you know, I learned from him and we became friends. But you know, multifamily is a lot more complicated than what we teach. You know, understanding a pro forma for single family is probably anyone could figure that out. Multifamily is a little more complicated. There's so much more I want to ask you, and I you know, there's so many things. But first, how did you get the money for that first building? Did you save it?
Yeah. So, like, you know, I was a late bloomer. So anybody listening that's in their 30s or 40s or 50s, it's never too late to start. You know, I worked in corporate America from the time I was 22 until the time I was 35 is when I read that book and went to my first seminar. So I had 13 years of working mainly as an engineer and then sales. I got into account management and sales, made six figures for the second part of those 13 years. So I was able to save money. And, that's one thing I learned from my parents is the way to financial freedom was to save. Now, I don't believe that anymore, but, so basically in my 20s and early 30s, I was living below, doing all the things they tell you, right? Live below your means. If you don't have like all the middle class paradigms that Kiyosaki teaches, don't go into debt, live below your means, save 10, 20% of your paycheck, invest in your 401k and your IRA. I did all that stuff.
Mm-hmm.
And so I was able to buy my first deal, and I'll never forget it. I bought it when I was 35 years old, and it was $976,000. I put $194,000 down and got a $776,000 loan. That was my first deal.
That must have been a scary day.
Yeah, the problem was now you're out of money, right?
Yeah.
Now you're out of money. And now how you do your second deal, that's where you got to learn how to syndicate, or you just stop.
Mm-hmm. Yeah, or you improve it somehow and, refi, get the money out, do it again. Okay, so fast forwarding, because there's a lot in between. I think Rich and I met you, I don't know, 7 years ago or something. And you were, boy, was the timing good. It was hard to know, but you must have known something. But you went all in. You have been now sharing stages with the man who changed your life, with Robert Kiyosaki. You're kind of a regular at his events or, at the same events. What was that like the first time you met him and then when you were speaking on the same stage?
Well,
speaking
honestly,
of Robert Kiyosaki.
I was starstruck. It's funny because Kathy, you know how it is. Like you influence a lot of people, and I'm sure a lot of people come up to you and say, "Oh, Kathy, I want to thank you and Rich for changing my life." And I get that because we make a big impact. But Robert's book changed my life. Never met him in person. Never been to one of his seminars. And then we started buying apartments, and then my wife and I created an education program. So his books changed my life in the year 2000. And then it's like 2016, 2017 time frame, and I meet Robert Kiyosaki at a real estate guys event, our mutual friends at the real estate guys. And I was starstruck. I didn't know what to say. I was just like one of those people that are like, "Oh, Robert, you changed my life. Oh, I want to thank you." And he was just like, "Wow, whatever, And,
He's over it.
and so the learning there, by the way, and now I'm around like Grant Cardone, Tony Robbins, is you just got to be like a cool regular dude that they want to hang out with, because if you're not, they ain't gonna want to talk to you, And,
you gotta hide the starstruckness.
Yeah. So, but I can tell you that, Robert's been on my stage twice. I have a cell number. We're acquaintances. I'd like to say we're friends, but friends could be an overused term, but he knows me. I've called him. I've made introductions, but I don't call him every day, and hang out. But it's it is pretty cool that we've come full circle.
Yeah, and every time I kind of checking out your Facebook, you are doing something incredible. It's really like you and Jen are just living the dream. It's incredible, the places you've traveled. Is your mom still around to see how far you've come?
No, my mom passed in 2015. And it's interesting because my mom wanted me to be an engineer so bad, and I became an engineer. And then she was so proud of me when I got an MBA. And then I got into real estate, and she was like, "You don't even need a degree to do real estate." And so when I went from an engineer to a salesperson, I made more money. But in my mom's eyes, I downgraded myself. And then when I went from sales to real estate, in her eyes because you could do real estate with a GED, right? I downgraded myself, and I don't think she ever really knew what I did, because at the last from 2012 to 2015, she had, well, I don't know if it was Alzheimer's or dementia, and maybe I don't fully understand the difference, but she suffered from memory loss or accessing her memory, and so I don't really know if I did, but this is a whole story. But I believe that she knows what I do now because I had a unique experience, and I believe that she knows what I do now.
Oh, oh, how cool. I can't wait to hear about that sometime.
Well, the short story, if you want to know, is I was
I
at
do.
a mastermind. I was at a mastermind with Tony Robbins, and he brought in a spiritual medium, which I thought was total BS. And next thing you know, the guy's telling me unique, specific things about my mom, like right now. And it wasn't stuff that like you can make up, like, oh, your palm is, like these palm readers in Hong Kong and stuff like that. Like it was really weird to the point. And so I'm just saying, like, I believe that my mom knows what I'm
That's
doing now.
incredible. Okay.
Yeah.
Now you're making me want to. I've never been to a Tony Robbins event, so maybe I need to do the next one. Okay. So for our audience, let's get into the nuts and bolts because that I could go on to the spiritual side of things all day. And we're just going to go completely to the other end of like detail and strategic stuff. So what would you say is the big difference in learning that people need to have when it comes to multifamily versus single family? Because full transparency, multifamily still scares me a little bit. I've done 2 really big deals. They were hard. We had problems with them. And so what are the basic differences and the most important things people need to understand about a bigger asset like that?
Well, so I think it's a paradigm shift
Mm.
because my first deal was 32 units. My second deal was 30. My third was 250. I had over 1,000 doors as a syndicator. And then I went and did one single family home, and I thought it was hard doing a single family home because I had to put the ads in I was in Houston, Texas. We had a publication called The Green Sheet. I don't know what you have in California, but this was back in 2011, 2012. I'm writing the ads. I'm answering the phone when people call the ads. I'm going to meet the prospective tenant to show them the house, and they don't show up. And then they move in and they don't pay the rent, and I'm going to court. And then they move out, and I'm walking the unit, and I'm meeting the maintenance guy or the handyman and having to hold the keys. See, in an apartment building, you don't do any of that. The management company does the leasing. They oversee the website. They put the ad on apartments.com. They hold the keys. They collect the rent. They go to court. They oversee the asset. They walk the vacants. They oversee the make-readies. They oversee the renovation. And I can do all this from anywhere. So I have, I guess it just depends on like your perspective, because when I've had that one single family home, and you might ask, well, why did you buy a single family home? And that's another story too. But like to me, Kathy, that was hard.
Yeah, that makes it. I mean, you can have a great property manager for however many units you have, but I see your point. I mean, self-managing is not something I'd want to do either. But okay, so then you've got the understanding the debt service ratios, just understanding the commercial lending. What do people need to know about that, and especially today?
Yeah, so like right now, and what are we? September 19th, 2022. There was a time where the experts would say, you need to have dry powder because there's going to be a day and a time where real estate's on sale. And right now, apartments are on sale. There's a deal that one of my mentees was looking at in April for 28 million. He got it under contract for 23 million. But the challenge is the lenders aren't loaning 80% anymore. They're loaning, 60%, 65%. And the interest rates aren't 3.5, they're 5.5.
Mm-hmm.
So look, Tony Robbins says this. 80% of success in anything is psychology, or what we would call mindset. And I know it sounds hokey. It really does. But the people that believe that they don't need to work on their mindset are the people that need to work on their mindset the most. And so, yes, you need to know all these things. But like the first deal I did in 2002, the interest rate was 6.375% on that $774,000 loan. And they're still below that now. So, now that, like, earlier this year, Kathy, the rents were going up, interest rates were 3.5%. And there was so much what I call stupid money chasing deals.
Yeah.
That, my students complained like, "Man, it's so competitive. It's free offer on this deal. How am I going to win this deal? I got to overpay." Well, now it's the opposite. Now it's like brokers are calling me to make an offer on the deal.
Yeah.
But now the lenders are less aggressive. So like, you could always find a reason not to do something. So like, I'll just tell you, like at the end of the day, the cash flow right now is lower than it was 6 months ago. It is. You could buy the deal for 28 million at 3.5% with an 80% loan, and you'll cash flow higher than if you bought it for 23 million, but at a 65% loan at 5.5%. Your cash flow will actually be higher if you paid the 28 with the better debt. But now we're getting at a better basis. Mm-hmm. And so what I've done, Kathy, and you probably know this, but I don't do commercial. I do apartments. Like I don't build, I buy. I buy B and C class buildings, maybe sometimes A, but I don't do mobile homes. I don't do commercial. I like when I say commercial. The only commercial I do is market rate apartments. And I don't even do student housing. I don't develop apartments. I buy existing properties. But what I found is that if I'm willing to pivot strategies, how I underwrite deals, the expected returns and the type of returns, is it cash flow? Is it upside potential? Is it value add? Is it depreciation? And I look for all of those. But like right now, the cash flows are going to be a little lower than they were before. But your basis, meaning like you can buy it now cheaper. Mm-hmm. And over time, the prices go up and they recover. So like, I believe the financial markets are going to be, that's February, it's September 19th. The Fed's going to raise rates again tomorrow, 75 or 100 basis points. My guess is almost even 100. I was thinking 75, but based on everything I'm seeing now, I'm going to bet that it's going to be 100.
Yeah. I'm
going to bet it's going to be 100.
Yeah.
And then they're going to raise them again in November and again in December. And the debt markets hate not knowing what rules to play by. But once they stop raising rates, they're going to know what rules to play by, and things are going to calm down. And by then, I don't want to say it's going to be too late, because like people somehow think like, oh, I'm going to time the market. But by the time you time the market and then get in, people like me that are already in, we already have the relationships, we already have the equity, we already have the track record, we're going to get the deals. So what I tell my most experienced students, to the newbies, to the people that never heard me before that might be like listening to this show, is if you want to be in apartments, you got to get started, because there's always a pivot that you can make with your underwriting, your strategies, your debt. But that's what people need to know right now, is that loans are going to be at a higher rate and a lower LTV, and you need to raise more money, but you could buy deals at a discount. Does that make sense what I'm saying?
Absolutely. I mean, what if you had your preference? Would you rather pay more with a lower interest rate or pay less with a higher interest rate?
Well, I've been doing both. So like like since July, just so you know, since July I bought 1,600 units and I syndicate deals now. So I don't want to be, just to be transparent, I don't own all 1,600 of these units, but I'm a GP and I have I put in money in every one of my deals, but my ownership interest is above and beyond my equity investment. That's what it means to be a GP, a general partner in a deal. But I've done 1,600 units, $186 million just since July. And none of these deals are going to cash flow really well right now because the debt's so low and the rate's so high. But we're buying at a discount. Like the basis of what we're buying the deals at is lower than it's been in quite a while. But then last year I was buying deals and you could say I was paying top dollar, but they were all cash flowing better because the debt was better. So like if you're willing to adjust your, last year I was getting better cash flow and tax advantages and less upside, and now I'm going to get a lot more upside on my deal, tax advantages, but less cash flow. Does that make sense?
Yeah, absolutely. Okay, so let's talk cap rate because this is still something after all these years that confuses me a little bit. I'm just being kind of transparent and I do want to take your course so I understand it better. So, we underwrite a lot of things and you're making assumptions. People are making assumptions about the exit cap. How do they make those assumptions? How do you possibly know what that exit cap's going to be?
Yeah, so I'll tell you how I do it. And it's been a pretty good way to go. So an exit cap rate is where you expect the cap rate to be when you're going to exit the deal. And so what I try to do is I try to look at what's a kind of a historical rate? Like, for example, let me just give you, and I'm better at using examples. So like before interest rates started skyrocketing, say first quarter of 2022, believe it or not, people were buying, C plus deals, class C plus deals, and that might be another question. Well, what's C plus versus B versus A? But people were buying like 1980s construction deals in, income levels in the 45 to 50,000 range. So that might be a C plus deal in Dallas, which is not the same as California, but in Dallas or in Tampa. And they were buying these deals at like a four cap. That's what they were buying. But that was way below the historical.
Right.
And so like we might buy deals at a four cap based on actuals, but we would underwrite an exit cap 5 years from now at like 5.5, 5.75, because, historically a 1980s property that has that demographic is not a four cap. Okay.
Right.
It would be a little higher. And ironically, the one thing I think that's going to save a lot of my students is that now, back then they were like, Brad, your underwriting's too conservative. The market's a four cap. We should be exiting, our underwriting should show a four cap exit or maybe a 4.25. It's conservative. It's 25 bips higher than it is right now. And I'm like, no. Now is at an all-time low. Let's keep that reversion rate, which is your exit cap 5 years from now, closer to 5.5%, 6%.
Okay.
Guess what? Now that the interest rates are going up, people were saying, oh, the cap rates have gone up to 5%, 5.25. Those same students that were complaining to me that I was too conservative, now like, oh, thank God I listened to you, Brad, because I underwrote my deals at a 5.75 cap rate and I bought it at a 4, but now cap rates are a 5 and I'm still in the money. An acquisition cap based on what's at the market now, but reversion cap rate, I'm always going to be a lot more conservative and have that exit cap rate be higher than. Now, I don't want to say always. I mean, there could be a time where, the market's really soft and maybe you're buying at a 7 cap rate, maybe I would underwrite it to be a little bit lower. So the bottom line is, like, what I've been doing and the methodology that I've been using is, when I look at underwriting, I look at historical numbers. Like, there were, last year, rents were going up 20% in some markets. So what I do, my underwriting that is on acquisition for the first 12 to 24 months, I would do what's called mark to market. So I would mark the rents up to the market. So I might give myself that 20% rent bump the first 12 to 24 months of ownership. But after I get that initial rent bump, I'm doing 2 to 3% a year. And I know other people that were not doing that. They were being more aggressive and they were showing 5-6% rent growth. They were marking it up to market, but then showing 5-6% a year because they were thinking, well, but that's insane, because rents historically don't ever go up 5 to 6% annually over the long term. They go up like 2%. And that's still market driven. Like, there are some markets where rents aren't going up at all. So you got to know what's going on in that market by getting access to market data. And there's a lot of sources where you could get market data for a fee, and you could buy market data for different parts of the country through like CoStar or Yardi or RealPage. And, some of these data sources that's what they do, is they gather that data and they provide historical and actual, rent growths, expense growths, cap rates, sales comps. And so you got to be a student of the game.
Yeah, absolutely. I mean, so when you look at historical cap rates, is there a time frame that you like to use? I mean, obviously pre-COVID would be helpful because we know that was just a lot of insanity over the last couple of years and unusual dips and highs. So when you are looking historical, are you saying the last 10 years, the last 20 years average? Are you picking like 2015? I mean, how do you pick
the last years? Because this is just my opinion, but when I got into the business, 1970s assets were, a C-class deal was a 1970s asset. Well, that was when I got into it 20 years ago. Now it might be a 1980s asset, right? But a typical C-class deal, I remember when I got in the year 2001, like, it was 7.5%, 8% cap rate. I don't know if it's ever going to go back to that. Like, I don't know if it's ever going to go back to that. Like, I personally don't think it'll ever go back to that. I think there's what causes a decrease in cap rate is an increase in demand. And I think that there's so many reasons why people are more tuned into investing in multifamily now. And I could be totally wrong, Kathy, but it's like, I use an analogy of my dad. And the analogy that I tell in my seminars is, my dad thinks that, when he was young, bread used to cost a quarter a loaf. But it's like, I'm like, Dad, it's never going to be a quarter again. Like, you're never going to be able to buy a C-class deal for $30,000 a door. And here's why: the rents were $400 a month back then, and now they're $1,100 a month. So it's never going to be $30,000 a door again. It's just not.
Mm-hmm.
Like that deal that I bought in 2002, that 32-unit deal, the rents were $450 a month, and I paid $30,000 a door, and my interest rate on my loan was 6.375%. Today, the rents are $1,200 a month. You'd pay $100,000 a door, and up until 3 months ago, the interest rate would have been 3.5%. Now it's 5.5%. But if you look at the rent, the interest rate, the debt, you'd probably get a return that's very similar to what you would have gotten 20 years ago, if that makes sense.
Yeah, that's amazing. Because, so yeah, I think that's what, you need to repeat that, because, we're seeing that too. And those of us who have been doing this for a little while, I look at some of the stuff we're buying today and we're helping real wealth investors buy, and I kind of look at it and go, this is weird. It's not that different than when I started, because rents have gone up. And yeah, so that's kind of essentially what you're saying, is somebody who comes into multifamily today, or just, let's just say, investing today, you think they could possibly get a similar type of return that you got when you started?
I mean, yes, possibly. I mean, but like, just to repeat what I said, if you think it like, and let me just say it a different way too, because see, you're an expert in 1 to 4 units. And remember when you asked me and you said apartments seem hard, and I told you, well, single family seem hard to me, right? A lot of it is what it is that you call it mindset, call it your comfort zone, call it your, what it is that you do versus, are you an insider or an outsider? There's 3 or 4 different ways that I described it, right? So to me, I've had people on the perimeter of multifamily. Like I remember in 2016, they were like, Brad, I want to get started now, but don't you think it's the top of the market? Don't you think you need to wait until the market crashes? And I'm sitting there, it's 22 now. And some of these people are like, Brad, I feel like such an idiot because I didn't do anything for the last 6 years.
I'm one of them.
but you've been doing stuff in your zone, right? Yeah. If I'm assuming you're buying 1 to 4 units, like hotcakes, right? And you probably always find a way to make those deals work because you're an insider, and I'm the same way in multifamily. So like that first deal I bought with $30,000 a door, rents for $450 a month. I put 20% down, and my loan was 6.375%. So somebody with a cash flow calculator could probably say, okay, well, $450 a month times 32 units times 12, that's the income. You take a 10% vacancy factor. Oh, expenses were probably $3,000 per unit per year, which they're now probably $5,000 or $6,000 because taxes went up, insurance went up, inflation. This was 20 years ago, payroll. I mean, everything goes up over time, but the rents have also gone up from $450 to $1,100. So the income is exponentially, not exponentially, but the income is 3x higher. The expenses are not 3x higher. The income is 3x higher. The expenses are 2x higher. So overall, the NOI is higher now than it was before. The price per unit is higher now than it was before. The debt, even now with the latest rates, the debt is still lower right now as of September 19th than it was 20 years ago, in terms of the cost of borrowing. So the returns might be around the same. I mean, I could need to pencil it out that the returns would still be pretty good.
Yeah,
even if you're paying $100,000 a door.
That's very comforting. I want to see if there's any questions. I don't see any right now, but if anybody wants to put any questions in, do so. All right. So I just want to say that I had called you and said, Brad, I want to learn multifamily because I waited a long time. I'm one of those people that waited too long because I need a mindset shift on that. And then you were sweet enough to say, well, why don't you come out to my event? And if you're coming out, why don't you speak? So I'm going to talk about the economy or whatever else we talk about. But if you will just kind of give a little bit of information on your upcoming event in Dallas.
Yeah, so this is and it's right around the corner. So the dates are September 30th, October 1st, and October 2nd. The location is Dallas. Dallas is easy to get to from anywhere. You fly into DFW Airport or Love Field. And it's a multi-speaker event. And I'll be speaking a lot. I can't help myself, Kathy. I'm a teacher at heart. But I'll have 9 different speakers, and you're one of them. And I know you're going to speak about markets. But we're going to have Ed Milet, who's like one of the best known entrepreneurs of the world. And a lot of people don't know about Ed, but he actually got his entrepreneurial start in real estate and made millions of dollars in commercial real estate. And he's actually owned some apartment buildings. He's a great teacher. Gitzler is here, and he's, an accomplished business owner, and he's also married to Sarah Blakely, who started Spanx, and she's a billionaire. So Jesse's essentially a billionaire himself. Tom Wheelwright, and I know that you know Tom, but Tom is the Rich Dad advisor for Kiyosaki and the whole Rich Dad network. And he's also my wife Jen's CPA as well, and does our tax returns. and he's going to be digesting the so-called Inflation Reduction Act that we passed. Yeah, so we have a lot of great speakers, and I would love for you to.
I'll just put it in the show notes. Well, Brad, it's been really fun to have you here. Let me just check and see if there's any questions. Nope. Okay, good. Well, I look forward to seeing you there. I will say Rich does have a man crush on Ed Mylett, so I wish he was coming with me. I'll get to meet him. So wonderful. I really look forward to seeing you soon and learning. And again, I'll make sure that people know how to find out more about this event in the show notes here and where you listen to podcasts. All right. Well, have a great evening doing something fun, and give your beautiful wife a hug for me. I can't wait to see her.
Awesome. Great to see you.
And thank you for joining me here on The Real Wealth Show. If you want to get in touch with Brad, visit bradsumrok.com and check out his events page. I'll be speaking at his upcoming event, AIMNatCon, on September 30th in Dallas. You can get the details in the show notes, and I hope to see you there.
The views and opinions expressed in this podcast are provided for informational purposes only and should not be construed as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, go to realwealthshow.com.